In our last video, we defined what overhead exactly means, and if we really want to start figuring out where that overhead is hiding, where do we know and calculate what our overhead is, we need to start to look at a basic financial statement. That is going to be the profit and loss or income statement. A P&L has a very simple calculation at its very core. It's taking the revenue, everything the practice collected, it's subtracting from it all of the bills, all of the expenses, and what's left over is the income. The other numbers that you'll see, terms that you'll see here, the revenue will be called the gross revenue or gross income. And then after you remove all of the expenses, that net income, that below the line number, is what the dentist is to have been reported to have taken home in salary. This is a very simplified sample income statement or profit and loss statement. And again, there's lots of other numbers that you'll see on here, but every income statement that your accountant should be preparing for you will have these essential elements listed here. So at the top is the period of time for which this is reported. So you should be, in my opinion, getting an income statement, a P&L, at least twice a year. If you're only getting this information once a year, it's not enough frequency to make really good decisions for your business, as you'll see as we fill out this concept in the next videos. So first you're going to find out what the period of time this is for. Is it every 6 months? Is it quarterly? In this case, we're looking at an annual income statement. So first we look at our gross income. Fee income in this example is, let's say, $600,000. Now, you'll also see then after this any adjustments and refunds, but in our simplified example, we'll say that our total gross income was $600,000. Okay, great. Well, now let's get into what it cost to run that business that generated $600,000. We see a list of expenses. Payroll would be for all our staff. Here we see highlighted dental supplies and the amount of cost that occurred. And so little by little, we're chipping away at that $600,000. Our total expenses in this example is $400,000. So that leaves our net income, a simple calculation, $600,000 minus $400,000, a net income of $200,000 for this practice. That is theoretically what the dentist would have taken home and been paid in salary, or if this was a partnership, would have been split up amongst the partners. As we'll find, there is still even more detail to go into here. Because, for example, if I was to ask you, all right, you paid $70,000 in your dental supply bill. Is that a lot? Is that right around your target? It's hard to know just by looking at these numbers. We need to do some deeper analysis of our overhead to figure out where we are.